Good evening, everyone, and welcome to Case by Case weekly webinar. And today we're talking about dynamic rebalancing and smart exits in investments. This is brought to you by Smallcase in association with Five Capital Quantitative Investing. And today we have a very special guest, Mr. Devendra Bairathi. He is the founder of Five Capital Investments. He's a SEBI registered investment advisor. So, Dave, welcome to the webinar. How are you feeling?
I'm feeling very good. Thank you so much, Abel, for lovely introduction. Looking forward to this interesting topic with you and everybody on the webinar. I welcome everybody on.
Sure. So I hand over the control to you. All right. So glad to have you here. Very excited.
Thank you so much. Hi, good evening, everybody. Before we move to the content, let me just give a little background about myself, and then we will go to the topic for today. So I'm founder of Five Capital. I'm CB registered investment advisor. I have more than 20 years of experience in quantitative investing and finance. Before that, I worked with Deutsche Bank, Stern Stewart, SAP, and Infosys in investing and consulting roles. I'm a BTech Gold medalist from IIT BHU Varanasi and MBA in finance from ISB Hyderabad. I've been investing in Indian equity markets using quantitative methods. I have developed several quant-based systems for Indian equity market. So that's brief about me. And now I will move over to our content for today, which is dynamic rebalancing. So let us first understand why rebalancing is necessary. As we have always been reading in all investing books, one should buy stock and you should buy it only if you can hold it forever for 10 to 15, 20 years. However, if we look at the way technology and advancements are developing and shaping the world, I think this buy to hold forever days are not so relevant. It should be buy and hold only if it's relevant. So we should hold an investment if it is relevant in today's world. And I'll just give you a brief example. On the slide, you see a picture of a Choluteca bridge. This Choluteca bridge is in US and it was built in late 1990s. There was an area where used to be very heavy storms, and there was a need to connect two land parcels. And over there, people called up some of the best engineers, architects. They took probably the best technology at that point of time, and they put together this 484-meter long Choluteca bridge, which was an engineering marvel of that point of time. And it was very relevant at that point of time. However, as time passed, the wind direction changed, the flow of the river changed, and the river, which was flowing below the bridge, it started flowing away from the bridge. And all the roads which were leading to the bridge and going away from the bridge, they got blocked, and the bridge stood strong, and it's still there. The point is it relevant today? Probably the answer is it's not relevant anymore. Similarly, if you look at it, your portfolio, there may have been some stocks which we might have bought 10, 15, 5 years back, which were very good at that point of time, which were very relevant in that era. But if they are not relevant today and we still keep holding them, they don't serve any purpose for us. And hence, rebalancing is very necessary to align your portfolio so that we don't have any Choluteca stock or investment in our portfolio. And how do we rebalance? How do we rebalance across asset classes? So if we look at it, we have investments from low risk to high risk category. All of us have some investments in each category. And it is very important that based on our risk understanding, based on our risk profile, we need to rebalance our overall portfolio. And we need to look at each sub-asset class from its risk perspective. So for a low risk portfolio, the rebalancing should be accordingly. On the other hand, for a high risk portfolio, where there is a lot more volatility, a more frequent rebalancing is required. So one should always look at sub-asset class from the risk perspective and accordingly should rebalance that. And how do we do that? Um, as you know, that market goes through a cycle of expansion and contraction in every 4 to 5 years. Market goes up and down, and as market goes up and down, the risk keep changing accordingly in the market. And this is how you should use these economic cycle to rebalance your portfolio. So for example, if you look at 2020 itself, this has been a year when there has been a massive movement in the market from a massive correction to a peak again, and one needs to rebalance its allocation across equities and less risky investments accordingly. So if markets are becoming very expensive or very pricey, one should consider decreasing the equity allocation a little bit and move towards more safer assets, and vice versa. If the markets are becoming very cheap and markets are going through a tough phase, one should accordingly increase allocation towards riskier assets. If we do this dynamic asset allocation simply between equity and other asset class, that itself leads to at least 2 to 3% additional alpha per year. And this was one study done some time back, where on a 15-year period, rebalancing was done on the portfolio across asset classes. And on a 15-year period, a rebalanced portfolio provided more than approximately 60% addition return, which works out close to 2.5% return per year. And hence rebalancing becomes very important. And I'll give you an example. Let's say 2008, if you take an example, it's year 2008, and if you look at some of the companies which were very relevant at that point of time, probably companies like Unitech, Reliance Communication, and many other stocks which were very relevant and in demand at that point of time, they are not relevant anymore, and hence it becomes very important for each one of us to replace or rebalance those stocks with the stocks which are more in demand. For example, Naukri, a company which came much later, and it has done extremely well. So Bharti Airtel, for example, if you had a Reliance Communication in your portfolio and Bharti Airtel, so Bharti Airtel has done very well. So accordingly, one should rebalance your portfolio. And so once you rebalance your portfolio at the asset level, another important aspect is how do you to rebalance your portfolio at the sectoral level. Now, in the chart over here, you see the sectoral allocation in Nifty basket. So if in Nifty index, if you look at the red line, in 2008, financial sector has almost 12% weight in Nifty, which in 2018-19 moved up to almost 40%, which means in over last 1 decade, if your portfolio had a higher financial sector allocation, it created more alpha for you. On the other hand, if you look at the gray line, which is oil and gas sector, which was 25% in 2008-9, it came down to almost 8% in 2020. So oil and gas sector, if you had allocation towards or a higher allocation toward oil and gas sector, even if market moved up, you still lost wealth. Hence, a sectoral allocation is also very important. And you need to just keep an eye how which sectors are moving, what are the trends in the market, and accordingly rebalance your sectoral allocation. Uh, if we look at it between 2009 to 2015, auto and pharma sectors did extremely well. They created significant amount of wealth. Bajaj Auto, Aurobindo Pharma. There are several names which became a multi-bagger for people. Once tide turned against pharma sector in 2015-16, all of us know that stocks like Sun Pharma, Lupin, and all these stocks over the last 4 5 years, they have just simply destroyed wealth. I mean, these large cap names have corrected more than 50-60% in last 4 5 years. On the other hand, index has gone up in last 4 5 5 years. So it is very important that you align your overall portfolio along with the whichever the sectors which are aligned currently in demand. If we look at the financial sector, which made a peak of around 40% in 2019-20 from 12% in 2008 and 9, has now slightly started coming down. So one should think about rebalancing accordingly. Now this has been a very difficult year for everyone due to COVID, and all the sectors and companies have gone through a massive up and down. We collected certain data about revenue and EBITDA growth for companies across the sector, and this is for Q1 data. And we saw which sectors did well and which underperformed because of the current health crisis. If you look at the telecom, chemical, financial, and technology sector, they have still done reasonably okay, where revenue and EBITDA trends have been positive. On the other hand, consumer discretionary, real estate, infrastructure, these sectors, revenue and EBITDA trends have been extremely negative. So one should look at this information and see how you are going to allocate your capital. So after you allocate your fixed income and equity or asset allocation, once you do that rebalancing, next is this sector allocation, and one should look at that in a very objective manner. Once you're done with your sectoral rebalancing, how do you look at the stocks and how do you rebalance that? Now, let's take an example. At any point of time, you build a portfolio of 10 stocks. Uh, what happens? Uh, Stocks keep moving up and down. There are four zones in which stocks probably will move. One is a wealth creation zone, which is a strong company and a strong sector. Second is a wealth accumulation zone, which is a strong company but in a weak sector. Third is a wealth reduction zone, which is a weak company but in a strong sector. And fourth is a wealth destruction zone, which is a weak company in a weak sector. So, for example, a wealth creation zone could be a let's say TCS, a good company in a strong sector, technology sector. In the orange one, a strong company in a weak sector, let's say Oberoi Realty, which is a strong company but in a weak real estate sector. A wealth reduction zone, weak company in a strong sector. So we can take example for any telecom or any telecom or pharma company today, but in a strong sector. And similarly, a wealth destruction zone, any weak company, any highly levered company in infra sector, which is a weak sector, and company also is very highly levered, that is a weak company in weak sector. Whatever investments we do, every 2 to 3 years, our investments will move from wealth creation to wealth destruction zone. And our job as an investor is to very dispassionately move these investments into wealth creation zone. So if out of 10 stock, over 3 or 4 stocks are part of wealth creation zone, which is very, very good. However, if our 2 or 3 stocks fall into wealth destruction zone, we should simply very objectively rebalance them with the stocks which are part of the wealth creation or wealth accumulation zone. And that's how we will preserve our capital, and also we will create more wealth for us. Um, One more discussion which has been happening a lot of late uh, is about investments into US markets, developed markets versus emerging markets. Now you see a chart of EM versus developed market performance for last 15 years. And if you look at it, emerging markets have underperformed developed markets for almost 10 to 15 years now. And I believe that if we look at the trend, emerging market has just started coming out of this bear cycle almost after 10 to 15 years. And they are starting a new leg of bull run, in my opinion. And if you look at the November data, FIs have invested more than 50,000 crore in India. This is one of the highest ever FI investment in India. So emerging market are going to be very, very important. And I think this decade, 2020 to 30, should belong to emerging markets compared to the developed markets. So when one is looking at investing across international markets, a rebalancing across emerging market is also very important. So this is how we should look at the rebalancing. I'll just once again conclude that part. Rebalancing across asset classes from equity, fixed income, and then rebalancing across sectors. Constantly move our investments from weak sector to strong sector, which are more in demand. And third, rebalancing across stocks, where our job is to move investments which are in wealth destruction zone to move towards a wealth creation zone. So stocks which are very, very weak, we should move them towards those stocks which are doing well in current environment. Um, Now let's talk about exit. Now exit is one of the most difficult decision. If you look at it, everybody today, whoever we talk to, most of the time we hear, I bought this stock, this sector is looking good, this stock is looking good, I read this research report. Most of the people have more clarity about entry than exit. And in one of the research, it came out less than 10% people actually have any exit plan. There is no exit plan. Most of the people have an entry plan, but there's no exit plan. And that, I think, is the biggest challenge. And I'll give you one very simple example. Even if you are one of the smartest investor, but if you don't have an exit plan, chances are that sooner than later in a market cycle, you will get trapped. I mean, let's take an example. Abhimanyu was a great warrior, and he was he went into the Chakravyuh. He knew how to get into the Chakravyuh, and he fought very well. But he did not know come out of it, and because of that, he had to suffer. Similarly, in investing also, if you make great stocks, you buy amazing stocks, but if you don't have a good exit plan, chances are that that will not work for you. A stock which you buy at 100 rupees, if it goes up to 200 rupees and comes down to 50 rupees and still you don't have an exit plan, then it doesn't help you. On the other hand, a stock which, if you buy at 100 rupees, goes down to 80 rupees, you have an exit plan, you exit that, and then probably buy it later at 50 rupees, it still create wealth for you. So having an exit plan is a very, very important aspect of investing. And this, why it is so important. As we lose, if our investments start losing capital because of market correction, it becomes much more difficult to break even. Till the point you lose 5 to 10% of your capital, it is fine because you have to come back probably in the similar amount to break even. But if you lose anything more than 30 to 40%, now your portfolio has to almost come 2 to 3 times to for a break even. If you lose 50 to 60% of the capital, even to break even now you need around 150% return on your portfolio. So it is very, very important to put a floor on your overall investment, and put a plan, put an exit plan which ensures that there is a floor. As an investor, your main goal should be to very smartly exit those investments which are not doing well. And everybody could have a different yardsticks. You can exit at 10 to 20% loss from the entry to ensure that you don't doesn't fall more, or somebody can look at slightly higher stop losses based on the volatility of the stocks. And at the same time, it is equally important that we keep our winning stocks intact. Winning stocks are the one which are going to create our wealth. So try to create a floor on your stock, and to try not to create a ceiling on your investment. So, for example, if you buy a stock at 100 rupees, if it goes up 130, all of us try to sell it because it's 30% gain for us. On the other hand, if a stock we buy at 100 rupees, if it goes down to 70, we never sell it because it's a 30% loss for us. And in reality, it should be opposite for wealth creation. If something has going to 130, that means the things are going right for that company, and the chances that it may go up further. So we should keep hold our winning bets, and our stocks which are not doing well for us, we should very systematically, dispassionately exit them and rebalance them with the ones which are doing well in current environment. And I'll just again give an example, from my experience over last 20 years of investing journey. Let's when we board any train, right, we know where we want to go. We don't board it in until unless we know the destination. Now there are 4 scenarios which happen when we board it in. If train keeps moving toward our destination, we sit very patiently and we reach our destination. Same thing should happen with our stocks. If a stock which we buy, it's going up, we should just simply hold it. We should not try to exit it in anticipation that it will fall. Similarly, if train breaks down during the journey, we exit the train. If our investments start doing bad or for any reason, even if there's some loss, 10%, 15%, 20%, we should exit it. And we should rebalance it to some other investment, which is doing fine. If a train starts moving to opposite direction of the destination for any reason, we exit the train. So let's say we buy a stock at 100 rupees and it goes up to 200 or 250 rupees. Should we sell it that point of time? In my opinion, we should not, because we don't know whether 250 will become 300 or 200. However, when from 250 it comes down to 200 or 180 rupees, where we see a clear U-turn in the long-term trend of the stock, that's where we should exit it. And if we put that as a process, the chances are that we will be able to capture the maximum upside in our stocks. So our aim should be not to get the highest point, but exit whenever the trends are changing for us. Now, how do you set these kind of systematic exits? You need to set up the rule for exit even before you enter the investment. And can there be any standard rule? I don't think so. These rules have to be specific to your investment psychology, your risk appetite. But the important thing is there should be rule, and the rule should be consistent and disciplined. We at Phi Capital, we use quantitative methods like standard deviation, price, and volume-based triggers for exit of our portfolio stocks. Whenever any of these triggers happen, we just simply exit and rebalance these stocks. We also use stop loss principle, again by price, volume, and volatility. I don't advise people winning trades early. Winning trades should be exited only after long-term trend has changed from rising to falling. So a stock which is, let's say, move hunt from 100 to 200, it should not be exited at that point of time. Rather, it should be exited when it again from 200 to 170. So you know that the long-term trend has changed to falling now. Core principle of the portfolio level is never lose more than 1 to 2% of your portfolio in a single stock. So if you're building a portfolio of 15 to 20 stock and you're allocating 5% of your capital into one stock, ensure that you do not lose more than 1 to 2% of your portfolio value in one single stock. So that way your capital will always remain intact. Never ever average buying, uh, never add to the losing stocks to decrease the buy price, because that way you are basically adding to the weak stock which are anyway not doing good for you. And similarly, let your winning stocks work for you. Don't rush to exit them. So your entire exit should be process should be planned in a way where your winning stocks stay with you for a long time. I mean, for example, Aurobindo Pharma in 2009, 2013, it was 60 rupees. And in 2020, it is almost 700, 800 rupees. Uh, there are so many such examples of stocks which have gone 10 times, 15 times. So if you keep your winning bets on stocks, these winning stocks can create a lot of wealth for you. So don't put any ceiling that I want to exit at 15% profit, 30% profit. Let them grow. Similarly, put a floor for the stocks which are not doing well for you. Don't let them eat your capital. And this is just, again, some of the things which I really learned from cricket. When we look at the cricket match, there are times when a good team comes into a situation where some they lose some early wickets, during batting. Now when the next batsman come, he doesn't come with a mindset to hit sixes and fours. He rather comes with a mindset that he has to just simply rotate the strike, take singles, and build the inning once again. And only when the situation is comfortable they start hitting. Neither they lose the pitch nor they become aggressive. They just do what is required at that time. Similarly, in investing, there are risk will come for us for sure, and risk will come suddenly at some point of time. Now our job as an investor is to manage this risk systematically. I mean, we shouldn't think about in leaving investing because we had some losses. We should rather think about setting up the process. We should rather think about managing the risk, and accordingly we should deploy our investment. So we should rebalance our investments in a way so that we can manage those risks and we can manage our investment psychology. So that's about exits. I'll just repeat once again of the key principle of exit, that um, let your loss making stocks go quickly out of your portfolio. Set the rules whichever you're comfortable. 10%, 20% loss, it should be one consistent rule based on your understanding. Let your winners run. Don't exit your winners in hurry, because if one or two winners you have in your portfolio, they'll take care of your entire portfolio. And follow the rules. Now very quickly I will touch upon our process. So we use quant based investing process. We use programming languages to screen more than 500 stocks in the market on a real-time basis. All these stocks are monitored, and their specific volume, standard deviation, and price-based trigger, which where we read them and look for the long-term trend in the market. Whenever any trend is broken, we rebalance the stock with another stock. It's fully mechanical way to do it. We also look at few qualitative factors in our portfolio stocks like leverage, corporate governance at a very high level. And if any of those issues are hit, then we don't touch those stocks. But predominantly, it's a pretty much a quantitative mechanical system what we have developed over last 10 years, where we are screening stocks on a real time basis. We have last 20 years of data from exchanges on which we have done a lot of back testing, and all these portfolios are live now for several years. And we have basically two strategies. One is a blue chip strategy where we are investing into top 10 to 15 large cap stocks out of top 100 stocks. And the philosophy is very simple: retain the winners and exit the losers systematically. And some of the sample stock currently in our portfolios are Dr. Reddy, Pi Industries, Jubilant Food, Naukri. These stocks, which are they are up more than 40 to 75% since our entry this year itself. And this is our performance compared to the benchmark. This is a comparatively, I would say, a slightly average to low risk small case, where we are investing in very good quality 10 to 15 blue chip stocks, and we are following very strong mechanical exit systems to retain the winners and exit the losers. The second one is growth small case. Here we are looking at top 400 mid and small cap stocks out of Nifty 500, and we are building a portfolio of 20 to 25 stocks. Again, the same principle: winner stays, losers move out of the portfolio. Here we are looking at those stocks which have historically done well, and however they have gone through a tough patch over last couple of years and now rebounding. So some of the sample stocks what we have in the portfolio today is Persistent, India System, Apollo Hospital, Max Financial. Again, most of these stocks are up 50 to 100% since our entry. With the same principle, we retain the winners and exit the losers. So we don't have more than 15 to 20% loss in any of the portfolio stock, and our winning stocks typically stays in our portfolio for 2 to 3 years. Yeah, that's all from my side in terms of rebalancing and exits. And now I'm happy to take questions. All right. I have got a question: how to know which sectors are strong? So I will just go back to this slide where we said, right now, if you look at it, the slide itself is telling you a very simple way is how the sector allocation in the Nifty is changing. So, for example, if you look at it, oil and gas is falling again and again since 2008, and it's still not started moving up. So in my opinion, that's not a strong sector. Financial sector, which have done extremely well, has just started coming down. In my sense, is probably it is peaking out and may probably struggle or come down more from here. If you look at the telecom sector, green line, which was very strong in 2008, it remained quite bad between 2009 to 2016. Now it has started moving up. So in my opinion, it's a strong sector. So one way to look at it, how if you look at the market, which companies from which sectors are delivering you high returns, and that's where you know that this sector is in demand. What is I have okay, another question is, what is the ideal number of stocks to include in a small case? It could be anything. Typically I suggest anything between if it's a large cap portfolio, up to 15 stock is good enough, because risks are evenly diversified and you have across the sector exposure. However, if it's a mid and small cap portfolio, I suggest somewhere around 20 stocks, which can be part of the small case. When small case suggests rebalance, do we get short-term capital tax? So basically, all the stocks are um, in your demat account, under your name. So depending on whether you are selling it, any particular rebalancing is happening for the stock in less than 1 year time, then it will be a short-term capital gains tax. If it is more than 1 year time, then it will be a long-term capital gains tax. It all depends when it has been bought or part of that particular small case. I have another question, which says, when invested in a small case, do we as investors have to do anything regarding rebalancing or exit? I guess case takes care of it. Yes, that's absolutely right. So whenever any rebalancing is happening, you will get a notification on the app about the rebalancing, and you have to just approve it. Once that happens, then all the rebalance will happen automatically. So entire process is quite streamlined. You will get the rebalancing trigger. You have to just approve it. Once you approve it, it will go automatically. You don't have to individually go and do the rebalance. I have one question which says, generally for a long-term investment, how much stop loss should be kept? There's, as I said, there's no specific rule. It all depends on what kind of investment process you're following, and what kind of stocks you have in your portfolios. For example, if you're looking at a large cap stocks, I typically look somewhere around 15%. That's good enough for me, that if things are not going fine, I exit that. If it's the mid and small cap, I normally look at 20 to 25%. However, again, it could be different for different people based on their systems. And for us also, these 15 or 20% numbers are not hard coded. They are based on volatility. So for us, a low beta stock, for example, a stock in pharma and technology sector, for it, the exit will be very different than a stock which is part of the banking sector, which is a high beta and more volatile stock. So we use volatility a lot in defining these kind of stop losses, which are pretty much dynamic. There's a question: how do retail time markets and particular shares to rebalance? Uh, I am of the view that timing of the market is as is very difficult, and I don't subscribe to that view. So whenever the rebalancing is coming to your way, just do it systematically, because it's more important to be aligned with the system. So whichever small case you have taken, whichever process you're following, just stick to it, because timing the market becomes a very judgmental call, and normally it doesn't work, in my opinion. If the situation would be like pandemic like this year, would the exit happen to the complete portfolio, or the rebalance would be there? Again, it depends on different small cases. In our case, if for example, between March and April, we moved almost 40 to 50% in cash. We were sitting 50% in equity and 50% in cash. As I said, that dynamic asset allocation is inbuilt part of all our small cases. And as risks start increasing, portfolio will automatically start moving towards cash systematically. And as then market started moving forward, May, June onwards, we started redeploying the capital. So today we are fully invested into the market. But to answer the question, if a situation like this happens again, portfolio slowly will keep moving towards cash to protect the capital. I have a question which says, how exactly I will rebalance in my portfolio? So rebalance will come to you automatically through small case, and you have to approve it, authorize it, and once it is done, then it will happen seamlessly. So I have a question: exit strategy, can you elaborate? At the initial stage, you think it is a loser, and company rebounds and become big winner in your portfolio. Absolutely right. That's always possible. Please understand, it's not possible. You are none of. I mean, it's not possible to be right in the market at all point of time. And once we have that clarity, this scenario will certainly happen, that you exit a stock, and then it may rebound and it can become a multi-bagger. Now, typically what we do, so let's say we buy a stock at 100 rupees and assume it comes down to 75 rupees, we will exit it. As systems are screening the market on the real-time basis, assume the stocks moves up to again 90 rupees or 100 rupees. System will again catch it, and we will re-enter probably at a higher price. But this may be one of a scenario where we exited at a lower price and have buying at a higher price. We may by doing the process, we may avoid several such stocks which we exited at 75 rupees and then they came down to 5 rupees or 10 rupees. And hence, as a process, if you do that, in some cases it will happen that you may have to buy the stock again at a higher price, but you will avoid all the big losses in your portfolio. So this really works beautifully if you have a process or rules to exit your system. Any stop loss principle, as I said, no specific, again depending on the everybody's investment portfolio and psychology. Typically, as I said, if you have a 20 stock portfolio and if you have a 5% allocation, try not to lose more than 1% of your overall portfolio in one stock. So don't wait for a stock to fall 50%, 60%, 70%, because then it doesn't make any sense anyway to exit it. Typically, keep that in mind that if you exit a stock between 15 to 20, 25% loss, you can still come back for, through rebalancing. Should a long-term investor with time horizon of 10 years have any debt fund in the portfolio? Again, depending on your risk appetite, depending on your overall investment goals, yes, one should have a debt fund. Again, how much one should have, it depends on what stage you are in your life and what financials you have. There's no one standard rule that you should have 70% in equity or 30% into debt fund or vice versa. There are people who do 100% equity. There are people who do 100% debt fund. How comfortable you are with the risk? That, as you know, that equity always comes with slightly more risk than debt funds. So if you are following the principle of dynamic asset allocation and you want to rebalance your portfolio between equity and fixed income, it's a good idea to have certain amount of capital towards the fixed income as well. There are a few shares like HUL which good fundamental but loss. Now is it good to invest now? As I said, that's again a same thing. It's about entry only. Even so, you can buy any stock, I think, at any point of time, depending on you have a process in place. So if you buy HUL, if you believe that this is going to work for you, uh, you can buy that and put a put an exit process for that. That if 2 months, 3 months down the line, this investment is still not working for you, or it's still giving you a loss, exit and move somewhere else. I think more than the picking the stock, the setting the process of buying and selling, setting that entry and exit process, that really is very important for wealth creation. I have a question. On an average, how often do you rebalance list of companies in small case basket on an annual basis? We rebalance once in a month, definitely. And in case of any extraordinary movement in the market, we might rebalance probably more than once. But anywhere between 1 to 2 rebalance per month is what we have been doing. I have a question. It is showing around minimum 71,000 to invest. What if I want to invest 100,000? Yeah, so you can invest minimum 71,000, and then any amount above that you can invest. The small case will automatically compute the numbers in terms of the quantity of the stocks, and it will you can deploy that. That's not an issue. How is technology sector to invest now? Yeah, technology is always a great sector from long-term perspective because there are no leverage and very good profitability, and so I believe that technology should always be part of a should always be part of a long-term investing portfolio in some form. If I buy one stock in a company on January and one in December and sell both in February next year, how is the tax calculated? One in short term and in long term. That's right. That's absolutely right. Is there a need for exit from a small case if you are invested for the long term? Will the rebalance take care of all the price fluctuations? Yes, absolutely right. There's no need to exit if you're investing for a long term. And anyway, equity investing, you should look at investing for the long term, not for the short term. And yes, rebalance will take care of all the price fluctuation in the market. The idea of the rebalancing is exactly that, to keep the portfolio relevant. A stock which probably somebody we advised 3 months back, if it is not relevant today, there's no point in holding that stock, and through rebalance we exit those stocks. Can I customize small case? Uh, at least not our small case. I mean, you can create your own small cases if you want. I think that's the functionality available. But if you're subscribing to any existing small case, I don't think so customization is possible. I mean, you can choose the amount how much you want to invest, but beyond that, only thing what you can do, you don't apply the rebalances if you don't want. So that kind of customization you can do if you want. What is the difference between quant investment versus momentum investment? I think momentum investment is one aspect of quant investment. Quant investment is something which is quantitative in nature, which also includes arbitrage investing, which also include pair investing and many other form. Momentum is one aspect of quant investing, and quant is bit more, you can say, is a bit more detailed and mathematical when it comes to looking at the past trends. So, for example, in our case, we look at almost last 20 years of data when we do back testing of our strategies. What is the minimum investment embedded in small cap case? I think it is around 50,000 rupees. What if I create my own small case in terms of rebalancing? Yeah, you can create your own small case. That's absolutely fine. How much additional fund in percentage term is required during a rebalance? How do we keep ourselves adequately funded? No, there are no additional funds are required during a rebalance. Typically, a small case is invested, let's say 100 rupees. Now the rebalance will also happen at 100 rupees. The small case is not going to ask 125 rupees or 130 rupees. Whatever rebalance will happen, it will happen assuming that you have 100 rupees. Now, for a minute, let's assume that 100 becomes 80 for you. Then rebalance happen, keeping 80 rupees in the mind. And if 100 becomes 120 for you, then rebalance will happen, keeping 120 in the mind. So you don't have to allocate any additional capital. You can increase or decrease to your small case based on your preferences. In the small case, we have to do lump sum or we can do monthly investment too. You can do both. You can do lump sum, you can do monthly. Both the options are there. It's absolutely your choice. If you have 10 stock and I sell one stock, will it be included in the rebalance? See, at the end of the day, all the stocks and everything, as I said, is part of, is with you. So whenever the next rebalance comes to you, it will, once you approve it, then it will bring it back to you to the 10 stock because you're doing the entire rebalance. So, however, I mean, as all the securities are with you, you are free to sell one if you want. I mean, there's no force of not that you can't sell. What should be the reasonable ROI expectation with your low risk small case? See, it all depends on the market movement. All the performance numbers are there with you on the small case website. I would say in the long run, anywhere between 15 to 20% looks reasonable to me, subjected to the market movements. But yeah, somewhere around 15 to 20%. I have a question. Payment of subscription at the upfront or part of the small case, any other module such as profit sharing, same like AS with? No, there's no profit sharing module here. It's all payment or subscription. In this case, it's quarterly payment. So you can pay for the quarter, and if you're happy, you can continue subscribing to it. If you're not happy, you don't have to further subscribe to it. So payment is only for a quarter, and it's a fixed fees. How do we decide whether we have to go for long-term investment or short-term investment based on stock performance? No, it's not. I think that decision has to be done by you, whether you are investing for long-term or short-term, not because of the stock performance, right? Today, if you are buying any particular stock, uh, it, if you're buying for 2 years, accordingly, you should select the stocks which are fitting in that long-term criteria. If you're buying for 5 days, accordingly, you should select the criteria, not if a particular stock is good for long-term or short. What are the handling charges for your small cases? It is 2,500 rupees per quarter, including GST. 2,499 per quarter, including GST for each small case. For 5 cap blue chip strategy, the return shows 22.37%. So we should consider the fees and capital gain at 20% of this. Capital gain is not 20%. Capital gain, if it is long term, is 10%, and short term it is 15%. And yeah, fees will be will be separate than this. Yes. 70, and I have another question. Is 70,000 rupees required every month or one time? It is one time. Once you invest 70,000 rupees, then you subscribe to small case. You don't have to invest every month, and then you can increase it as at per your convenience. If you want to move from 70,000 to, let's say, 1 lakh rupees, you can add that much capital. Is SIP possible? Yes, SIP is possible. The minimum amount is initially 70,000 rupees to subscribe the portfolio, and after that you can do the SIPs. If you sell one of the stocks in your small case, wouldn't that skew the health of the basket? So that these rebalances are done systematically. We are not selling any stocks because we don't like it, or it's not looking good. There is a reason, as I explained, that rebalancing is necessary. If a particular company is not doing well today, it becomes important to exit that because there is an opportunity cost, and there can be more losses in that. So portfolio will rather become better. Idea of rebalancing is to portfolio to more realign with the current market trends and probably generate higher alpha. Whether we can continue with our brokers or should we sign in with you? So through small case, there are 10 listed brokers like Zerodha, Upstocks, and many others. If you have brokerage account with any one of them, then you can just simply subscribe on a click. You don't have to come through any other broker. I think if there are any other questions, I'm happy to take them. Then there's a question. Is the subscription fees fixed for one small case or applicable every unit which was? Subscription fees is fixed for one small case. Once you buy one small case, all the rebalance and everything will happen automatically. You don't have to every time pay. The rebalances are part of the subscription fees. I have one more question. As this time market P is very high, should we start investing now or should we wait for some time for market correction? There is no one answer. According to me, it all depends on how has been your investment. It is very different for everybody. So for example, if somebody has 20% investment in equity or have never invested, I would encourage the person to invest now if it is for long term, because I don't know or nobody knows that whether market will go up and down. Normally, timing the market doesn't work, in my opinion. And if you're investing for long term, 3 to 5 year, every time is a good time. So, and there are different pockets in the market. For example, growth stocks, some sectors, even if the market is going down, they will do well. So, depending on how you are invested so far, if your investments equity are less, I would suggest you to invest now and decide accordingly. I have a question. So a small case is a basket of stocks as well debt instruments like liquid funds. So when you sell stocks, the money move into liquid fund and vice versa. Right. So when you rebalance, either you will rebalance into another stock or you will rebalance into liquid Bs or any other liquid fund. That's absolutely right. So idea is that the markets are falling, markets are coming down very rapidly, then you will move more and more towards liquid funds. You will decrease the risk on the small case. Does small case is same for all brokers? Yes, small case is absolutely same for all brokers. Broker is an execution platform. Similar small case will go to everyone. For I have another question. For each 70,000 rupees, do we need to pay subscription fee of 2499? No. You can invest even 5 lakh rupees and pay 2499. Subscription fees is not limited to the small case investment amount. Subscription fee is linked to each small case, and minimum amount is 70,000. Above that, you can invest any amount. There is no restriction. So you can invest 5 lakh rupees and you can still pay only 2499. And that is actually the beauty of the small case, that fees is limited compared to many other products like mutual funds and PMS, where you're paying to 2.5%. In this case, at 2499, you can invest as much amount as you want. I have another question. I don't understand what is 2500 charge. I don't know. Small cases is charge. So this is subscription fees. So there are some small cases which are paid. So this 2499 is a subscription fees for the quarter. For this quarter, this is the amount. This is the fees you will have to pay. And once you pay this fees, then all the rebalance, all the adjustments will come to you automatically. You don't, and then you can execute them on a simple click. If I choose not to avail the subscription for the second quarter and then resume in the third quarter, is this possible? Yeah, absolutely fine. If you can come back at any point of time. Subscription is for the first quarter, and the second quarter you don't pay, you don't get the rebalance and updates, and third quarter when you come back, you will again get the rebalance and updates. How should the weightage of the stock should be done in a small case? Weightage is, again, in our case, it is decided by our program. It is by our process, and that's keep changing based on how the market is moving and whenever any rebalance is happening. How long we are holding these stocks? No specific timeline. If a particular stock in a small case is doing well, we intend to hold it as long as we can. Could be 1 year, 2 year, 3 year. Ideally, it will be long. If a stock is not doing well, then we intend to exit it earlier. We have an account with Upstock, so is it necessary to pay 70,000 or pay to 500? No, so you're not paying 70,000 rupees. You're paying only 2,500 rupees for the subscription. 70,000 rupees is your investment amount, minimum investment amount. And that stays with you. It is invested into your stocks. It is invested in stocks on your behalf in your name. So total fees to you is only 2,500 rupees and not 70,000 rupees. As a subscription fee is recurring every quarter, it will be charged automatically, or is it manual payment every quarter? It's both options are there. It can be charged automatically and it can be a manual payment. Choice is yours. Is this the right time to do a lump sum investment or wait for market to go lower? I honestly don't have any answer for that because I don't know. I'm very, very clear that I don't try to forecast the market. I try to follow the market. And the same question people asked when Nifty was 10,000. So the same question people asked when it was 11,000. So again, and then also I had the same view. I'm falling. So right now market is in good uptrend, and I can't say that the market will come down. We use quantitative process for stock identification. As I said, that we have last 20 years of data, and all the selection is done by programs. Yes, we use these quantitative investing methods for stock identification as well as exits. Mutual funds versus small case, which is better? both are very different. Small case is very effective, when it comes to the fee structure, as you're paying only 2499 per quarter. It's hardly 1,000 rupees per year, and you can invest as much as you want. And then everything is with you. All the rebalances are happening nicely, and you have very thematic and different small case, like quantitative small case, momentum small case. So I personally feel small case are a very good, strong investment tool. Uh, in your small case, our stocks are selected based on quant characteristic, or some expert opinion on your part include. So primarily, I will say 90 to 95% decisions are quant driven. There is probably a 5% element if through program a particular stock is selected which has some inherent fundamental or corporate governance issue, then we don't touch it. But otherwise, primarily quant, and of some kind of filtration is used by us to filter out any issues in the particular stock. I don't have an account with the platform. So you have to just simply go to the 5capital.smallcase.com. If you have any of the brokerage account with small case, you can just simply subscribe on a simple click. Else you can send me an email and I can help you with that. My email ID, I will just again put it for ease. Just 1 second, sorry. This is my email ID, and you can email me and can help. Um, Subscription charges are same across the brokers. Yes, subscription charges are same across the brokers. I've already shared fund performance. It's there on the website. You can just simply visit 5capital.smallcase.com, and performance across different time frame is available. So you can just see that. For Zerodha traders, whether fees exempted? No, I mean, for any broker you come through, you small case subscription fees will be there. On 70K one time every month, does need any investment? This is on 70K one time, and then no monthly investments are not required. You can add as and when you want. My email ID is there. It's devendra.bairathi at 5capital.in. I have shared the screen. It's on top of that. Subscription fees is 2,500 rupees, 2500 per quarter. Name of the small case is 5capital blue chip small case and 5capital growth small case. You can go to the website 5capital.smallcase.com, and from there you can see both the small cases. Right, I think I can just take a couple of last questions if we have. ETF again. ETF is a definitely a good investment tool. I personally feel both are important. ETF as well as active investing. It should be part of the portfolio. As we discuss about asset allocation, some amount of the capital should be invested into ETF, and some amount of capital should be towards active investing, like small cases. All right. I think we are done with the questions here. Thank you so much, everyone, for attending this webinar. And it was really exciting, and so many questions have come across, and I'm happy I could answer your queries. And please feel free to reach out to me for any queries you may have for me. My email ID is listed there. It's devendra.bairathi at 5capital.in, and you can connect with me on Twitter as well at Barathi Dev. And my small case microsite 5capital.smallcase.com, you can go through it, and all our small cases details are there. And you can also visit my website 5capital.in for more details. Thank you so much.
Thank you so much. Thank you so much, Dave. Really sorry, viewers, because of time constraints, we really have to close right now. But thank you so much, Dave, for the insightful session. It was really wonderful having you. How were the questions? How was your feedback? How do you think about the webinar? Do you have any suggestions or anything?
No, I think it was very good. It was very nice. I think it was quite engaging, honestly. And the questions were coming across the spectrum, from ETF to small case to mutual funds to taxes. So that way, I think it was quite a good group, and I really enjoyed.
All right, all right. Thank
Thank
you.
you so
Thank you
much,
so much.
Thank you so much for arranging this.
Sure, sure, sure. So, thank you so much, viewers. And so, we'll have to go now. Thank you so much. Have a great evening and have a nice day.
Thank you so much, everyone.